Hello everyone, welcome back to the channel. If you're new here, this is Financialistic and I'm here to help you grow financially and reach your personal and investment goals. Today, we are discussing about the top investment mistakes Nigerians are making and most importantly, how you can avoid them. So stay with me as I break down each mistake, and don't forget to like, subscribe and hit the notification bell so you don't miss any of the upcoming videos. The first common mistake is diving into investment without proper research. In Nigeria, new investment opportunities pop up every day, from cryptocurrencies to agrotech platforms. And while the excitement of high returns is tempting, going in blind can lead to disaster. Many people get swept up by ads promising sky-high returns. Some platforms might claim they will double your money in a month. And while that sounds amazing, it's important to dig deeper. Ask yourself questions like, how does this investment work? What are the risks involved? Is it regulated? Take your time to research each investment thoroughly. Visit platforms like the Securities and Exchange Commission's SEC Nigeria website to verify the legitimacy of any financial institution you are considering. Read reviews and seek out experts' opinions. Doing your homework is crucial to making sound investment decisions. The next mistake is one I see too often: investing because everyone else is doing it. It's easy to get influenced by friends or family who have invested in something and seems to be making big returns. But remember, just because an investment works for someone else doesn't mean it's the right fit for you. Investing out of peer pressure can lead you to pour money into something you are not comfortable with or don't understand fully, and that often leads to regrets. Stick to your investment plan. Focus on investments that align with your financial goals and risk tolerance, not what others are doing. When in doubt, ask yourself, does this investment help me reach my financial goals? If the answer is no, it's probably not for you. Number three mistake is the biggest one: chasing after unrealistic returns. We've all seen it before. Platforms advertising returns of 100% or even 200% in a short period. Look, if it sounds too good to be true, it's probably too good to be true. High returns come with high risk. There is no such thing as get rich quick scheme in the world of sound investing. Most of the time, these promises are just marketing gimmicks designed to lure in investors. And in the worst cases, they could be outright scams. Okay, so focus on investments with reasonable, steady returns. Products like treasury bills, mutual funds, or even money market funds might not make you rich overnight, but they are safer and more predictable. And remember, good investments grow over time. Patience is the key. Number four is not diversifying investments. All right, let's talk about diversification. One mistake that a lot of Nigerians make is putting all their money into one type of investments. Whether it's stocks, real estate, or crypto, relying solely on one asset class can be very risky. Diversifying means spreading your investments across different asset classes like stocks, bonds, and real estate. This way, if one area underperforms, others might still give you positive returns. To avoid making this mistake, make sure to build a balanced portfolio. Think about your goals and mix in a few stable options like fixed deposits or mutual funds with potentially higher growth assets. A well-diversified portfolio is a lot more resilient in the face of market ups and downs. Number five mistake is ignoring inflation and currency risk. Inflation is constantly chipping away at the value of your money. And if you're not factoring that in, your returns may not be as good as the same. For example, if you're earning 10% interest on an investment, but inflation is at 12%, you're actually losing purchasing power. Similarly, with currency fluctuations, your investments can lose value if you're only investing in local assets. One way to counter this is by including some foreign assets in your portfolio, like dollar denominated investments, and always compare your returns to the inflation rates to understand the real value of your gains. Another major mistake is relying on advice from unlicensed financial advisors. In Nigeria, many people turn to friends or social media influencers for investment advice, which can be very risky. Look, there's nothing wrong with getting insights from friends or online, but take this with a grain of salt. Unlicensed advisors might lack the training to guide you properly, and they may not be up to date on regulations or market conditions. So instead, seek guidance from certified financial advisors or verified professionals. Remember, real advisors will help you build a personalized plan, and they are accountable for the advice they give. Choose your resources wisely. Lastly, one of the biggest mistakes is not regularly reevaluating your investments. Just because an investment was a good fit a year ago doesn't mean it's still the right fit for you today. Markets change, and so does your goals. Regularly assessing your portfolio helps you make sure your investments still align with what you're trying to achieve. Ignoring this could lead to missed opportunities or even losses. So set aside time to review your portfolio at least once or twice a year, and then ask yourself questions like, is this investment still performing well? Are there better opportunities I should consider? This proactive approach keeps your money working for you efficiently. So there you have it, the top investment mistakes Nigerians are making and how you can avoid them. Remember, smart investing is about being informed, patient, and strategic. Avoiding these common pitfalls will help you make better financial decisions and ultimately get you closer to your goals. Thanks so much for watching. Don't forget to like this video, subscribe to the channel, and hit the notification bell so you never miss an update. And let me know in the comments which of these mistakes you've done in the past. I'd love to hear your thoughts. Until next time, stay savvy, stay smart, and happy investing.